Let me show you some math that should fundamentally change how you think about retirement accounts. A 25-year-old in the 22% tax bracket who contributes $6,000 annually to a Roth IRA for 40 years will have about $2.6 million tax-free at retirement. That same person, if they used a traditional IRA and invested the tax savings, would have about $3.1 million after paying taxes in retirement. That's a $500,000 difference. But here's what's shocking. Most financial advice tells young people to do exactly the opposite. And that backwards advice is systematically destroying retirement wealth for an entire generation. Before we go deeper, I need you to do something. If what I'm about to show you changes how you think about retirement planning, if it makes you question advice you've been given by financial advisors or read in personal finance books, hit that like button and subscribe to the channel. Turn on notifications. Because this conversation is going to contradict some very popular, very widely accepted financial planning wisdom. And you're going to want to come back to this when you're making these decisions. I'm Larry Fink. I've been managing money since 1976. Back when I was wearing an ugly brown suit and turquoise jewelry, looking absolutely ridiculous but hungry to understand how money really works. Today, I run BlackRock, the world's largest asset management firm. We manage over $11 trillion for institutions and individuals trying to build financial security. And over nearly 50 years of doing this work, I've seen certain pieces of financial advice become so widely accepted, so commonly repeated, that nobody questions them anymore. They're just assumed to be true. Financial gospel. And one of those pieces of gospel is this: always take the tax deduction now. Use traditional retirement accounts when you're young because you're in a high tax bracket. You'll pay less tax in retirement when you're in a lower bracket. That advice sounds logical. It gets repeated by financial advisors, by books, by articles, by financial planning software. It's become conventional wisdom. And for an entire generation of young, high-earning professionals, it's wrong. Catastrophically wrong. Wrong to the tune of hundreds of thousands, sometimes millions of dollars over a lifetime. And the reason it's wrong reveals something fundamental about how wealth gets built, about how tax policy works, and about how most financial advice is backwards because it optimizes for today instead of for 40 years from now. Let me walk you through the math, because the math is what matters. Not feelings, not conventional wisdom, not what sounds right. Just cold, hard mathematics. Let's say you're 25 years old. You're earning $100,000 a year. You're in the 22% federal tax bracket. You want to save $6,000 per year for retirement. You have two choices. Choice A. Contribute to a Roth IRA. You pay taxes on that $6,000 now at 22%, so it costs you $6,000 of after-tax money. But then it grows tax-free for 40 years, and you pay zero taxes on withdrawal. Choice B. Contribute to a traditional IRA. You get a $6,000 tax deduction, which saves you $1,320 in taxes that year at 22%. You invest that $6,000, plus you separately invest the $1,320 tax savings. Everything grows tax-deferred for 40 years. Then in retirement, you pay taxes on all the traditional IRA money when you withdraw it. Now, conventional wisdom says choice B is better because you're investing the tax savings. You have more total money working for you. And if your tax rate in retirement is lower than your tax rate now, you come out ahead. But let's actually run the numbers. Let's assume 10% annual returns, which is the historical average for stock market returns. Let's assume you do this every year for 40 years from age 25 to 65. In choice A, the Roth route, you contribute $6,000 per year after tax for 40 years. That's $240,000 in total contributions. At 10% annual returns, that becomes about $2.6 million at age 65. And every penny of that $2.6 million is tax-free. You pay zero taxes on withdrawal. Your spendable wealth in retirement, $2.6 million. In choice B, the traditional route, you contribute $6,000 per year pre-tax to the traditional IRA. That's $240,000 over 40 years, growing to $2.6 million, same as the Roth. But you also invest the annual tax savings of $1,320 in a taxable account. Over 40 years, assuming the same 10% return but accounting for taxes on dividends and capital gains each year, that grows to maybe $800,000 to $900,000. Now you're 65. Your traditional IRA has $2.6 million. Your taxable account has $850,000. Total, $3.45 million. But you haven't paid taxes on the traditional IRA yet. When you withdraw it, you'll pay taxes. And here's the critical question. At what rate? Conventional wisdom assumes you'll be in a lower tax bracket in retirement. But will you? Let's think about this carefully. If you've accumulated $3.45 million, you're going to want to withdraw enough to live comfortably. Let's say you follow the 4% rule and withdraw $138,000 per year. If you're married, after the standard deduction, you're paying taxes on about $110,000 of taxable income. At current tax rates, that puts you in the 22% bracket, same as when you were working. Maybe even higher if tax rates increase. So you pay 22% on the traditional IRA withdrawals. That $2.6 million becomes $2.03 million after taxes. Add the $850,000 from the taxable account, and your total spendable wealth is about $2.88 million. Compare that to the Roth scenario, $2.6 million, all tax-free. The difference is about $280,000. You actually ended up with less despite having more gross wealth, because of the tax drag. But wait, I said earlier there was a $500,000 difference. Where does that come from? It comes from a more realistic assumption about taxes in retirement. Most people who accumulate substantial wealth don't end up in lower tax brackets in retirement. Why? Because they have other sources of income. Social Security, which becomes taxable above certain income thresholds. Maybe a pension, maybe rental income, maybe part-time work or consulting. Maybe required minimum distributions from retirement accounts force them to take out more than they need, pushing them into higher brackets. And critically, tax policy changes. The current tax brackets are historically low and are set to sunset in 2025, after which rates increase. Over a 40-year retirement, it's almost certain that tax rates will be higher at some point than they are today for most people. If your effective tax rate in retirement ends up being 28% instead of 22%, suddenly that $2.6 million in the traditional IRA becomes $1.87 million after taxes. Add the $850,000 taxable, and you have $2.72 million total. Compare that to $2.6 million tax-free in the Roth. The Roth is now only slightly worse, and that's before considering the complexity and stress of managing taxes in retirement. But here's where it gets really interesting. These calculations assume you invest the tax savings from the traditional IRA in a taxable account. But most people don't actually do that. Most people take the $1,320 tax savings and they spend it. They don't even realize it's there. It just disappears into their cash flow. If you don't invest the tax savings, if you just pocket it and spend it, then the traditional IRA gives you $2.6 million gross, which becomes maybe $1.87 million to $2.03 million after taxes. The Roth gives you $2.6 million tax-free. The Roth wins by $570,000 to $730,000. That's the $500,000 difference I mentioned. And that's being conservative. In many scenarios, the Roth advantage is even larger. So why does conventional wisdom tell young people to use traditional accounts? Why is this bad advice so widespread? Here's what I've learned in 5 decades of managing money. Most financial advice is optimized for financial advisors, not for clients. It's optimized for what's easy to explain, what sounds good, what feels right in the moment. It's not optimized for what actually builds the most wealth over 40 or 50 years. The traditional IRA advice sounds smart. You're in a high tax bracket now, you'll be in a low bracket later, so defer the taxes. It's simple, it's intuitive, it gives you an immediate tax refund, which feels good. And most importantly, it's the same advice that works for older, wealthier people. See, here's the thing. For someone who's 55 years old, earning $300,000, in the 35% tax bracket, with only 10 years until retirement, the traditional route probably does make more sense. They're in a very high bracket now, they'll have a relatively short accumulation period, and they'll likely be in a lower bracket in retirement because they'll stop working. But financial advisors give the same advice to 25-year-olds earning $75,000. And for those people, the advice is backwards. They're not in a high tax bracket. They're in the 22% or 24% bracket. And they have 40 years for wealth to compound. And their incomes will likely grow substantially over their careers. And tax rates might be higher in the future. And they're most likely to actually forget to invest the tax savings. For young people, for people with long time horizons, for people whose incomes will grow, the Roth is almost always better. But they're getting advice designed for older, wealthier people. And it's costing them hundreds of thousands of dollars. I see this pattern constantly at BlackRock. We work with thousands of financial advisors who are trying to help their clients. And most of them, they mean well. But they're operating with rules of thumb that don't apply to everyone. They're using conventional wisdom that was developed for a different demographic and a different era. And the result is that millions of young people are using traditional retirement accounts when they should be using Roth accounts. They're taking tax deductions at 22% now, so they can pay taxes at potentially 28% or 32% later. They're optimizing for a small immediate benefit at the cost of a massive long-term penalty. Let me give you a concrete example. I know someone who's 28 years old, earning $85,000, works in tech, expects their income to grow substantially over their career. They asked their financial advisor about Roth versus traditional IRA. The advisor said, "Oh, definitely traditional. You're in the 22% bracket. Take the deduction now. You'll be in a lower bracket in retirement." So they've been using a traditional IRA. They're getting a $1,320 tax savings per year, which they mostly spend without realizing it. And over 40 years, this advice will cost them something like $400,000 to $600,000 in after-tax retirement wealth compared to using a Roth. Meanwhile, I know someone else, same age, similar income, who did their own research and chose the Roth. No one advised them to. They just ran the numbers themselves and realized the Roth made more sense for someone young with a long time horizon. Same starting point, different advice. 40 years from now, one of them will have hundreds of thousands of dollars more in spendable retirement wealth. Not because they invested better. Not because they saved more. Just because they made the right choice about which type of account to use. That's what I want you to understand as we go deeper. These account choice decisions, they seem small. They seem technical. Tax deduction now versus tax-free later. Who cares, right? But compounded over 40 years, they're some of the most important financial decisions you'll ever make. And most people are making them wrong. Not because they're stupid, not because they're lazy, but because they're following conventional wisdom that doesn't apply to them. They're trusting advice that's optimized for older, wealthier people. They're making decisions based on what feels good today rather than what builds the most wealth over decades. Let me be very clear about something. I'm not saying traditional IRAs and 401ks are bad. For some people, in some situations, they're the right choice. If you're in your peak earning years, in a very high tax bracket, close to retirement, the traditional route might make sense. But for young people, for people in moderate tax brackets, for people with long time horizons, for people whose incomes are likely to grow substantially, the Roth is almost always better. And the conventional advice doesn't reflect that. The conventional advice is one size fits all, and that one size happens to be wrong for millions of people. This isn't just about IRAs. This same backwards thinking applies to 401ks. Most people default to traditional 401k contributions because that's what their employer's plan defaults to, or because they want the immediate tax deduction. But many of them should be using Roth 401k contributions instead if their plan offers them. It applies to other account types. It applies to withdrawal strategies in retirement. It applies to conversion strategies, Roth conversions, that could save people hundreds of thousands in taxes but that most advisors don't proactively recommend. There's a whole system of conventional wisdom around retirement accounts that's optimized for simplicity and immediate gratification rather than for long-term wealth maximization. And if you follow that conventional wisdom blindly, you're going to leave enormous amounts of money on the table. I've spent my entire career thinking about how wealth gets built over long periods of time, how capital compounds, how small decisions today become huge differences decades later, how tax efficiency matters as much as investment returns, how optimizing for 40 years from now is more important than optimizing for this year's tax return. And what I've learned is that most people, even smart, educated, high-earning people, they don't think this way. They optimize for today. They follow conventional wisdom. They trust their financial advisor without questioning whether that advice actually applies to their specific situation. And they pay for it. They pay for it with lower retirement balances. They pay for it with higher taxes. They pay for it with less financial security and freedom in retirement. Not because they didn't save enough. Not because they didn't invest well. But because they made the wrong choices about which accounts to use and when. That doesn't have to be you. But it won't be you only if you're willing to question the conventional wisdom. Only if you're willing to run the actual numbers for your situation. Only if you're willing to think about 40 years from now, not just about this year's tax return. Over the next sections, we're going to go deep on this. We're going to look at exactly when Roth makes sense and when traditional makes sense. We're going to look at the factors that determine which is better for you specifically. We're going to look at Roth conversions and how they can save you massive amounts in taxes. We're going to look at how to think about this if you're already using traditional accounts and wondering if you should switch. And most importantly, we're going to talk about how to think like an institutional investor thinks about tax efficiency. How to optimize for long-term after-tax wealth, not for short-term tax deductions. How to make decisions based on mathematics and probability, not on conventional wisdom and gut feeling. Because that's how real wealth gets built. Not through following advice everyone else follows, but through thinking clearly, independently, about what actually optimizes for your long-term financial security. Let's begin. Let me give you the framework that institutional investors use to think about tax efficiency. Because once you understand this framework, the decision between Roth and traditional becomes obvious for your specific situation. The framework is built on a single question. What's your marginal tax rate now versus your expected marginal tax rate in retirement? If your tax rate now is lower than your expected tax rate in retirement, use Roth. Pay taxes at the lower rate now. Get tax-free withdrawals at the higher rate later. If your tax rate now is higher than your expected tax rate in retirement, use traditional. Take the deduction at the higher rate now. Pay taxes at the lower rate later. Simple in theory. But here's where everyone gets it wrong. They make incorrect assumptions about both sides of that equation. First, they overestimate their current tax rate. Someone earning $100,000 says, "I'm in a high tax bracket. I should use traditional." But they're not in a high tax bracket. They're in the 22% federal bracket. Add state taxes, and maybe they're at 27% or 28% effective marginal rate. That's not high. That's moderate. A high tax bracket is 35% or 37% federal. That's someone earning $400,000 or more if they're married. For them, traditional might make sense. But someone in the 22% or 24% bracket, they're not in a high bracket. They just think they're because they don't have perspective on what high actually means. Second, they dramatically underestimate their tax rate in retirement. They assume they'll drop from the 22% bracket to the 12% bracket or lower. But that's almost never true for people who accumulate substantial wealth. Let me walk through why. Let's say you're successful at saving. You accumulate $3 million in retirement accounts by age 65. You're married. You want to maintain a comfortable lifestyle. Let's say $120,000 per year in spending. You start withdrawing from your traditional IRA. That $120,000 in withdrawals is taxable income. After the standard deduction of about $30,000 for a married couple, you have $90,000 in taxable income. At current rates, that puts you in the 22% bracket. Same bracket you were in when you were working. But wait, there's more. You also have Social Security. Let's say that's $40,000 per year. Above certain income thresholds, up to 85% of Social Security becomes taxable. So now you have $90,000 from IRA withdrawals plus $34,000 from Social Security taxation. That's $124,000 in taxable income. You're solidly in the 22% bracket, possibly pushing into 24%. And we haven't even talked about required minimum distributions. At age 73, you're forced to start taking money out of traditional IRAs whether you need it or not. Those RMDs are based on your account balance and life expectancy. With a $3 million balance, your RMD at 73 might be $120,000 or more. You have to take it out, and you have to pay taxes on it, even if you don't need the money. So now you're forced into a higher tax bracket than you wanted to be in. And that RMD amount increases every year as you age. By your 80s, you might be forced to withdraw $200,000 or more annually, pushing you into even higher brackets. This is the reality of retirement taxation that nobody talks about. If you're successful at saving, if you accumulate substantial wealth in traditional retirement accounts, you don't end up in a lower tax bracket. You end up in the same bracket or higher, and you lose control over your income and taxation because of RMDs. Now contrast that with the Roth scenario. You have $2.6 million in a Roth IRA. You withdraw $120,000 per year. That's completely tax-free. It doesn't count as taxable income. You have Social Security of $40,000. Below the income thresholds, maybe only 50% is taxable, or $20,000. Your total taxable income is $20,000. After the standard deduction, you're paying taxes on essentially nothing. Your effective tax rate in retirement is close to zero. And there are no required minimum distributions on Roth IRAs. You can leave the money growing tax-free forever if you want. You can pass it to your heirs, and they inherit tax-free money. You have complete control over your income and taxation in retirement. This is the difference between tax-deferred and tax-free. Tax-deferred isn't tax-free. It's tax-delayed. And often, tax-increased, because you end up paying taxes at higher rates than you deferred them at, and you lose control over when and how much you have to withdraw. At BlackRock, when we manage money for institutions, we think obsessively about after-tax returns. We don't optimize for pre-tax returns. We don't care if something looks good before taxes if it's terrible after taxes. We care about what the client actually gets to keep and spend. Individual investors need to think the same way. You don't care about how much is in your traditional IRA before taxes. You care about how much you get to spend after paying taxes on withdrawals. That's your real wealth. That's what matters. And when you think in after-tax terms, the Roth advantage for most young people becomes overwhelming. Yes, you give up a small tax deduction now. But you gain tax-free growth and tax-free withdrawals for decades. The after-tax wealth difference is enormous. Now let me address the scenario where traditional actually does make sense. Because there are legitimate cases where it's the right choice. Scenario 1. You're in a very high tax bracket now, 35% or 37% federal, and you're confident you'll be in a much lower bracket in retirement. This typically means you're in your peak earning years, you're earning $400,000 or more, and you plan to live modestly in retirement on $100,000 or less. The tax arbitrage opportunity is large enough to justify traditional. Scenario 2. You're close to retirement, maybe within 10 years, and you need the immediate tax deduction for cash flow reasons. The compounding time is short enough that the Roth advantage isn't as large, and the immediate tax benefit matters more. Scenario 3. You're self-employed or have a small business, and you want to contribute very large amounts to retirement accounts through vehicles like a solo 401k or SEP IRA. The contribution limits are much higher for these traditional accounts, and the immediate tax benefit on very large contributions can be substantial. But notice what all these scenarios have in common. High current income, short time horizon, or unique circumstances. They don't describe most young people. They don't describe someone who's 25 or 30 or 35, earning $75,000 or $100,000 or even $150,000, with 30 or 40 years until retirement. For those people, for the vast majority of people in their 20s, 30s, and early 40s, the Roth is almost always better. And yet, that's not what the conventional advice reflects. The conventional advice treats traditional as the default and Roth as the exception. It should be the opposite. Let me show you another angle on this that most people don't consider. Tax rate risk. When you use a traditional IRA, you're making a bet on future tax rates. You're betting that tax rates will be lower in the future than they are now, or at least not higher. But that's a risky bet. Tax rates change. They change based on political control of government. They change based on budget deficits and national debt. They change based on demographic pressures from an aging population. And over a 40-year retirement, it's almost certain that tax rates will fluctuate significantly. The current tax rates, post-2017 tax reform, are historically low. They're scheduled to sunset in 2025, after which rates increase. Future administrations may increase them further. If you're deferring taxes now at 22%, you might end up paying at 28% or 32% or higher decades from now. With a Roth, you eliminate tax rate risk. You pay taxes at today's known rate, and then you're done. Forever. No matter what happens to tax policy in the future, no matter how high rates go, you don't care. Your money is tax-free. This is like insurance. You're paying a small premium now, the foregone tax deduction, to eliminate a potentially large risk later, the risk of much higher tax rates in retirement. And for most young people, that insurance is worth it. At BlackRock, we help institutional clients manage risk all the time. And one of the fundamental principles is, eliminate risks you don't need to take. Don't take risk for free. Only take risks that are compensated by higher expected returns. Tax rate risk isn't compensated. There's no higher return from taking it. It's just pure risk. So why take it? Use the Roth, eliminate the risk, and move on. Now let me talk about something that's even more powerful than just choosing Roth over traditional. It's something called a Roth conversion, and it's one of the most underutilized tax planning strategies available. Here's how it works. Let's say you used traditional IRAs or 401ks earlier in your career, before you understood the Roth advantage. You have $200,000 in a traditional IRA. You're now 45 years old. You realize that when you retire and start taking withdrawals, you're going to pay taxes at high rates, and you're going to have RMD problems. You can convert some or all of that traditional IRA to a Roth IRA. You pay taxes on the conversion amount in the year you convert. But then that money grows tax-free forever, and you pay no taxes on withdrawals in retirement. The question is, when should you convert, and how much? The answer: convert in years when your income is lower than normal. Maybe you're between jobs. Maybe you retired early and haven't started Social Security yet. Maybe you're taking a sabbatical. Maybe you had a business loss that year. Any year where your taxable income is lower than your long-term average, that's a conversion opportunity. You convert enough to fill up lower tax brackets. Let's say you're married and your taxable income for the year is $50,000. You could convert an additional $40,000 from traditional to Roth and still stay in the 12% tax bracket. You paid 12% tax on that $40,000 conversion, and then it's Roth forever. If you do this systematically over several years, you can convert substantial amounts at low tax rates. Maybe you convert $200,000 over 5 years, paying an average tax rate of 15% on the conversions. Compare that to leaving it in traditional, where you might pay 25% or 30% on withdrawals in retirement. The tax savings can be enormous. And yet, most people never do this. Most financial advisors never proactively recommend it. Why? Because it requires paying taxes now, which people instinctively resist, even when it saves them much more in taxes later. This is another example of optimizing for the short term versus the long term. Paying taxes on a conversion feels bad in the moment. It reduces your current year refund or increases your tax bill. But it can save you tens of thousands or hundreds of thousands in retirement. At BlackRock, we work with ultra-high net worth clients who do Roth conversions aggressively. They understand the math. They understand that paying taxes at 24% now to avoid paying at 35% later is an amazing arbitrage opportunity. They understand that eliminating RMDs and creating tax-free wealth for their heirs is worth the upfront tax cost. But this strategy isn't just for the wealthy. It's even more powerful for middle-income and upper-middle-income people, because they're the ones who are most likely to end up in similar or higher tax brackets in retirement if they're successful at saving. Let me give you a concrete example. I know someone who worked in tech, made good money, accumulated $800,000 in a traditional 401k by age 50. They retired early at 52. For the next 10 years until they started Social Security at 62, they had very low income. Maybe $30,000 per year from part-time work. During those 10 years, they converted $80,000 per year from traditional to Roth. Because their income was so low, they paid an average tax rate of maybe 15% on those conversions. They converted $800,000 total, paid about $120,000 in taxes over 10 years. Now they're 70. They're taking Social Security. They're withdrawing from their Roth IRA, all tax-free. If they hadn't done the conversions, they'd be taking RMDs from an $800,000 traditional IRA, paying taxes on every dollar at 22% or 24%, plus dealing with Social Security taxation, plus losing control over their income. By doing the conversions, they saved something like $300,000 to $400,000 in lifetime taxes. Maybe more. And they have complete flexibility and control over their retirement income. This is strategic tax planning. This is thinking like an institutional investor. This is optimizing for lifetime after tax wealth, not for this year's tax return. But again, most people don't do this. Most people don't even know it's possible. Their financial advisor never mentions it, or mentions it vaguely but doesn't help them implement it. And they pay for it with higher taxes and less control in retirement. Now, I want to address a common objection. People say, but I might need the money before retirement. Roth contributions I can withdraw anytime, but what about Roth conversions? Don't I have to wait 5 years? Yes, there's a 5-year rule on converted amounts. If you're under 59.5 and you convert money from traditional to Roth, you have to wait 5 years before you can withdraw the converted amount without penalty. But this is usually not a real constraint. First, if you're over 59.5, the 5-year rule doesn't apply to you. You can convert and withdraw immediately if needed. Second, if you're under 59.5, you probably shouldn't be withdrawing from retirement accounts anyway. That's not what they're for. If you need liquidity, you should have emergency funds and taxable investments. Retirement accounts are for retirement. Third, the 5-year rule applies to each conversion separately. If you convert $50,000 in 2024, you can withdraw that $50,000 penalty-free in 2029. If you convert another $50,000 in 2025, you can withdraw that in 2030. So with strategic planning, you can create a pipeline of converted money that becomes available on a rolling basis. The 5-year rule sounds scary, but it's really not a significant constraint for most people if they're planning appropriately. Let me give you one more angle on this. Estate planning. If you die with money in retirement accounts, what happens? If it's in a traditional IRA, your heirs inherit it. But they have to pay income taxes on withdrawals. And under current law, they have to withdraw it all within 10 years. So if you leave your child a $1 million traditional IRA, they might have to take out $100,000 per year for 10 years, paying taxes on every dollar, possibly at high rates if they're also earning their own income. If it's in a Roth IRA, your heirs inherit it tax-free. They still have to withdraw it within 10 years, but they pay zero taxes on those withdrawals. That $1 million is worth a full $1 million to them, not $700,000 or $800,000 after taxes. For people who want to leave wealth to the next generation, the Roth is far superior. It's a way to transfer tax-free wealth. And yet, most estate planning advice doesn't emphasize this enough. People focus on estate tax, which only affects estates over $13 million. But they ignore income tax, which affects every dollar inherited in a traditional IRA. At BlackRock, we work with families doing multi-generational wealth planning. And the sophisticated ones, they're converting traditional money to Roth specifically for this reason. They're paying the taxes now so their children and grandchildren inherit tax-free assets. They understand that the tax they pay on conversion is trivial compared to the tax savings for their heirs. But again, this isn't just for the wealthy. This is relevant for anyone who wants to leave retirement assets to heirs. Convert to Roth, pay the taxes now at your rate, and let your heirs inherit tax-free wealth. The gift you give them is the absence of a future tax burden. Let me synthesize all of this into a clear decision framework. Here's how to think about Roth versus traditional for yourself. If you're under 40, use Roth. Almost always. Unless you're earning $300,000 or more and are in the 35% bracket or higher, Roth is better. The compounding time is long enough that the tax-free growth outweighs the foregone deduction, even if you're in a moderately high bracket now. If you're 40 to 50, it depends on your tax bracket and retirement plans. If you're in the 22% or 24% bracket, probably still Roth. If you're in the 32% or higher, maybe traditional unless you plan to do Roth conversions later. If you're over 50 and within 10 to 15 years of retirement, the math gets closer. Traditional might make sense, especially if you're in a high bracket now and plan to live modestly in retirement. But even then, consider Roth if you want to eliminate RMDs and create tax-free estate wealth. And regardless of your age, if you have money in traditional accounts, look for opportunities to do Roth conversions. Any year with lower than normal income is a conversion opportunity. Fill up the lower brackets. Pay taxes at 12% or 22% now instead of 24% or 32% later. This is how you optimize for lifetime after tax wealth. This is how you think strategically about taxes instead of just reacting to this year's return. This is how institutional investors think. And this is how you should think too. Let's talk about how to implement this. Let me give you the complete mental framework for thinking about retirement account taxation. Because once you internalize these principles, you'll never make a tax-inefficient retirement decision again. Mental model number 1. Optimize for after-tax wealth, not pre-tax contributions. This sounds obvious, but most people violate it constantly. They're excited about getting a $3,000 tax deduction from a traditional IRA contribution. They feel like they're winning against the IRS. But they're not thinking about the $3,000 plus decades of growth that they'll have to pay taxes on later. The question isn't, how much can I deduct this year? The question is, how much will I be able to spend in retirement after all taxes are paid? That's your real wealth. That's what matters. When you shift to this mindset, the Roth advantage becomes obvious. Yes, you give up a small deduction now. But you gain tax-free growth and withdrawals forever. The after-tax wealth difference over 40 years is enormous. You're not optimizing for this year's tax return. You're optimizing for lifetime spendable wealth. Mental model number 2. Tax rates are uncertain, tax-free is permanent. When you use traditional accounts, you're making a bet on future tax rates. You're betting that rates will be the same or lower when you retire. That's a risky bet. Tax policy changes constantly. Rates could be much higher in 20 or 30 years. You don't know. With Roth accounts, you eliminate that uncertainty. You pay taxes at today's known rate, and then you have tax-free money forever. No matter what happens to tax policy, you don't care. You've locked in tax-free status. This is like buying insurance. The premium is the foregone tax deduction. The benefit is eliminating decades of tax rate risk. For most people, especially young people with long time horizons, that's an excellent trade. Mental model number 3. Control is valuable. Traditional IRAs force you to take required minimum distributions starting at age 73. You lose control over when and how much you withdraw. You might be forced into higher tax brackets than you want. You might have to take out more money than you need. Roth IRAs have no required minimum distributions during your lifetime. You control everything. You decide when to withdraw, how much to withdraw. You can leave money growing tax-free indefinitely. You can pass it to heirs tax-free. That flexibility and control has enormous value. When BlackRock works with institutional clients, we value optionality highly. Having options, having flexibility, having control, these aren't just nice features. They're financially valuable. The same applies to individual retirement planning. Mental model number 4. Pay taxes when rates are low, not when rates are high. This is the fundamental principle behind Roth conversions. If you're in a low tax bracket in a particular year, that's when you want to pay taxes. Convert traditional money to Roth, fill up the lower brackets. Lock in tax-free status at favorable rates. Most people do the opposite. They defer taxes when rates are low because they want the immediate deduction. Then they pay taxes later when rates might be higher. That's backwards. Think strategically about your entire lifetime of tax rates. Pay taxes when they're cheap. Defer paying when they're expensive. And increasingly, cheap means now for most young people, because current rates are historically low and likely to increase. Mental model number 5. Small decisions compound into massive differences. The choice between Roth and traditional seems small. A few $1,000s in tax deduction this year versus tax-free growth later. But compounded over 40 years, it's hundreds of thousands of dollars in after-tax wealth difference. This is true for so many financial decisions. The differences seem small annually. But compounded over decades, they're life-changing. That's why you need to get these decisions right early. That's why you can't just follow conventional wisdom without thinking. The cost of getting it wrong is enormous. Now let me give you a practical implementation plan. Step by step. Here's how to think about this for your specific situation. Step 1. Calculate your current marginal tax rate. Not just federal plus state plus any local taxes. Know exactly what rate you're at now. If you're under 30%, you should almost certainly be using Roth. If you're over 35%, traditional might make sense unless you plan to do conversions later. If you're between 30% and 35%, it depends on your specific circumstances, time horizon, and expectations. Step 2. Estimate your likely tax rate in retirement. This requires thinking carefully about several factors. How much wealth do you expect to accumulate? If it's substantial, you'll likely be in the same or higher bracket because of RMDs. Will you have other income sources in retirement? Social Security, pension, rental income, part-time work? These push you into higher brackets. What's your expected withdrawal rate? If you need to withdraw substantial amounts to maintain your lifestyle, you'll be in higher brackets. What do you think will happen to tax rates over the next 30 to 40 years? If you think they'll increase, that's another argument for Roth. Be honest with yourself. Most people assume they'll be in lower brackets in retirement, but for anyone who's successful at saving, that's usually wrong. Step 3. Make your primary retirement contributions to the account type that makes sense for you. If you have access to a Roth 401k at work, use it if you're under 40 or in a moderate tax bracket. If your employer offers a match, contribute enough to get the full match first, regardless of account type. Free money is free money. But then direct additional contributions to Roth if that's better for you. If you're self-employed or have side income, open a Roth IRA and max it out every year. That's $7,000 per year for 2024, $8,000 if you're over 50. Do this in addition to any workplace retirement plan. Step 4. Look for Roth conversion opportunities. Every single year, ask yourself, is this a year with lower than normal income? Maybe you're between jobs. Maybe you retired early. Maybe you had a business loss. Maybe you're taking time off for family reasons. Any year where your income is lower than usual, that's a conversion opportunity. Calculate how much you can convert while staying in the 12% or 22% bracket. Convert that amount. Pay the taxes from savings, not from the IRA itself. Repeat every year that you have the opportunity. Even if you don't have a low-income year, consider doing small conversions annually. Convert $10,000 or $20,000 per year, paying relatively low taxes, rather than letting all your traditional money compound and then paying higher taxes on everything later. Step 5. Think about Roth conversions as part of early retirement planning. If you're planning to retire before Social Security age, those gap years are golden conversion years. Let's say you retire at 60. You don't start Social Security until 67. From 60 to 67, you have 7 years of potentially low income. You could convert $50,000 to $100,000 per year during those years, paying taxes at very favorable rates, and eliminate most or all of your traditional IRA balance before RMDs start. This is advanced planning, but it's incredibly powerful. And it's something most financial advisors never proactively recommend, even though it could save their clients hundreds of thousands in lifetime taxes. Step 6. Run the actual numbers for your situation. Don't just trust conventional wisdom or rules of thumb. Use a retirement calculator that accounts for taxes. Model both scenarios, Roth and traditional, with realistic assumptions about your income, growth rates, tax rates, and withdrawal patterns. See the actual difference in after-tax wealth. See how much you'll have available to spend in retirement under each scenario. That's what matters. Not what feels good this year, but what actually builds the most spendable wealth over your lifetime. And if you work with a financial advisor, ask them to do this analysis for you. If they can't or won't, if they just default to conventional wisdom without running your specific numbers, you might need a better advisor. Now, I want to address the psychological barrier that stops most people from using Roth accounts or doing Roth conversions. It's the pain of paying taxes now. Humans are wired to prefer immediate benefits and defer costs. Getting a tax refund feels good now. Paying taxes on a Roth contribution or conversion feels bad now. Even when the long-term math overwhelmingly favors paying taxes now, the psychological pain of writing that check is powerful. This is loss aversion in action. The pain of paying $2,000 in taxes now feels worse than the abstract pleasure of avoiding $5,000 in taxes 30 years from now. The immediate is vivid and emotional. The distant is abstract and easy to ignore. But this is exactly the kind of short-term thinking that destroys wealth. You have to override this instinct. You have to think like an institutional investor, not like a human responding to immediate pain and pleasure. At BlackRock, when we make investment decisions, we don't ask, how does this feel? We ask, what does the math say? We run the numbers. We calculate expected after-tax returns. We choose the option that maximizes long-term wealth, regardless of how it feels in the moment. You need to do the same. Yes, paying taxes on a Roth contribution feels bad this year. Yes, paying taxes on a Roth conversion hurts. But that pain is temporary and small. The benefit is permanent and large. You're trading a little pain now for massive gain later. Reframe it in your mind. You're not paying unnecessary taxes. You're locking in tax-free status at favorable rates. You're not giving up a deduction. You're investing in tax-free growth. You're not losing money to taxes. You're buying insurance against future tax rate risk. The psychological frame matters. If you think about it as loss, you'll resist it. If you think about it as a strategic long-term investment, you'll embrace it. Let me tell you about someone I know who gets this completely. They're 32, earning $120,000 in the 24% tax bracket. Every year, they max out their Roth 401k, contributing $23,000. They also max out a Roth IRA for themselves and their spouse, another $14,000. That's $37,000 per year going into Roth accounts. If they were using traditional accounts, they'd save about $8,880 in taxes per year, which they could invest. But they're not. They're paying the taxes, using Roth accounts, and accepting a smaller immediate tax benefit. Why? Because they've run the numbers. They know that $37,000 per year for 33 years at 10% returns becomes $7.4 million, all tax-free. They know that if they used traditional accounts and invested the tax savings, they'd have maybe $8.5 million gross, but after paying 25% to 30% in retirement taxes, they'd have $6 million to $6.4 million after tax. By using Roth, they're ending up with $1 million to $1.4 million more in spendable retirement wealth. They're giving up $8,880 per year in tax savings to gain over $1 million in after-tax wealth. That's a 100 to 1 return on the tax they're paying now. They get it. They understand the math. They've overcome the psychological pain of paying taxes now because they can see the massive long-term benefit. That's the level of thinking I want you to achieve. Not, should I take the tax deduction this year? But, what decision maximizes my after-tax wealth over my lifetime? Now, let me close with the biggest mistake I see people make. They think, it's too late for me. I've been using traditional accounts for years. I've already made the wrong choice. No, it's not too late. You can start using Roth accounts now for future contributions. You can do Roth conversions to fix past traditional contributions. Every dollar you convert today is a dollar you'll never pay taxes on again. Every dollar you contribute to Roth going forward is a dollar of tax-free wealth you're building. Yes, you might have been better off if you'd used Roth from the beginning. But you can't change the past. You can only optimize from here forward. And from here forward, for most people under 50, Roth is probably better. Don't let past mistakes prevent you from making better decisions now. Don't fall victim to the sunk cost fallacy. Your past traditional contributions are what they are. But you control what happens next. I've spent nearly 50 years in this business. I've seen every kind of financial decision, every kind of outcome. And I can tell you, the people who build the most wealth aren't the people who never made mistakes. They're the people who learned from mistakes and adapted. They're the people who questioned conventional wisdom. Who ran the numbers for their specific situation. Who thought about the long term, not just the short term. Who optimized for after-tax wealth, not for this year's tax return. And critically, they're the people who overcame psychological barriers. Who were willing to pay taxes now to save much more later. Who valued control and flexibility. Who understood that tax-free is better than tax-deferred for most people in most situations. You can be that person. But it requires thinking differently than most people think. It requires questioning advice that sounds smart but doesn't hold up under mathematical scrutiny. It requires making decisions that feel uncomfortable in the moment but that you know are right for the long term. That's what separates people who achieve financial independence from people who just accumulate money but stay stressed about taxes. That's what separates people who control their financial destiny from people who let tax policy and RMDs control them. The framework I've given you today, it's not complicated. It's not secret. It's not available only to the wealthy or the sophisticated. It's just clear thinking about taxes, about time horizons, about after-tax wealth. Use it. Apply it to your situation. Make the right choice for yourself, not the choice that conventional wisdom tells you to make. And watch the difference compound over decades. If this conversation changed how you think about retirement accounts, I want you to share this video. Send it to someone who's using traditional accounts by default without thinking about whether Roth might be better. Send it to someone who's never heard of Roth conversions. Send it to someone who needs to understand that the conventional wisdom on retirement accounts is often wrong for young people. And join this community. Subscribe to the channel. Hit that notification bell. Because we're going to keep having these conversations that challenge conventional wisdom and help you think more clearly about building wealth. The path to financial independence isn't about following the advice everyone follows. It's about thinking clearly, running the numbers, and making optimal decisions for your specific situation. Roth versus traditional is one of those decisions. It seems small, it seems technical, but it's worth hundreds of thousands of dollars over a lifetime. Get it right. You have the framework now. You understand the math. You understand why conventional wisdom is often wrong. You understand how to think about this like an institutional investor rather than following rules of thumb designed for different people in different situations. Now go implement it. Choose the right account types. Do Roth conversions when opportunities arise. Optimize for lifetime after-tax wealth, not for this year's tax deduction. Your future self, the one who's 65 or 70 and withdrawing money completely tax-free while everyone else is paying 25% or 30% on every dollar, that future self will thank you. Think clearly. Act strategically. Build tax-free wealth. That's how it's done.